Hi, everybody. My name is Carl White.
And I'm Tammy Grossman.
And we're here to talk about a new government loan program that's going to help a lot of you out there. It's called the Harp 2.0. And we're going to talk about how this new loan program can be a huge benefit for you. So a couple things up front here. Tammy, could you tell us who this workshop is for, what we're going to cover, and what if we have more questions after listening to this one?
Well, the workshop is for anyone who wants to lower their interest rate, but they can't do it through a conventional loan because they're either upside down on their home or they have some issues like credit. Okay, some of the other things that we're going to be covering are what the program is, who qualifies, where folks can get this type of loan, and a whole lot more stuff like that.
And then if they have more questions when we're done, Tammy?
Well, at any time, they can call the number that's at the bottom of this screen. We'll be able to answer all of your questions and help you get the ball rolling. And while we're on the subject of contacting us, although we're going to try and make this really easy and put it in layman's terms, you may not understand everything that we're talking about. So again, just give our office a call and we'll have a private conversation about your exact situation.
Okay, so the bottom line today, we're going to talk about people that are upside down in their house and they're looking to refinance where they haven't been able to in the past. So that's a general consensus of what we're going to be talking about. So Tammy, let's jump right into this. Explain what is HARP 2.0.
Well, that's a great question. First, HARP, H-A-R-P, stands for a Home Affordable Refinance Program. And it's a special program that was designed for people who had a Freddie Mac loan or a Fannie Mae loan. And it allows people to refinance their loan through expanded criteria. In layman's terms, that means through looser guidelines.
Easier to get.
Right. So these would be people that might have trouble qualifying during today's tough credit standards, and or people who have negative equity in their home because of the decline in markets.
In other words, they're upside down on their mortgage.
Right, right.
All right, well, let's start off with some of the easy stuff. Who is going to actually be able to get this loan? Like, what's the general guidelines for this?
Well, basically, it's going to be anyone who obtained a mortgage prior to June 1st, 2009. But if you closed after that date, so say you were June 2nd, you're not going to be able to get this loan.
So anytime after that, this one doesn't apply. But there's other programs.
Yes.
So if you did get your loan after June 1st, 2009, still give us a call and we'll talk about. But this particular training is about the HARP 2.0.
Which is for anyone who got a loan prior to June 1st, 2009.
All right. And what about other hardships other than negative equity? Are there any other requirements? Like, do you have to have a hardship letter or anything like that?
Oh, no. In fact, hardship actually really doesn't apply so much for the refinance portion of it, except in terms of that negative equity. The biggest thing that we face is we still have to show that people are still capable of paying their bills. In fact, the program requires that homeowners are current on their mortgage right now and that they have not had any late payments in the last 6 months, and only one late payment in the 6 months prior to that. So let's say in month-wise, it would be months 7 through 12. They were only allowed to have one late payment, but none in the last 6 months.
So again, in the last year, you could have one late payment.
But it had to be in month 7 through 12.
Right. Now, even if you are late more than that, again, there's other programs. Again, give us a call in the office and we'll discuss those other programs. But this particular program allows only one late payment in the last 12 months, specifically months 7 through 12. Okay, got that.
And the other thing that we're looking for, aside from that negative equity, is we're looking for somebody who might have had like a higher debt to income. That means that their bills were a little bit higher than what they were earning. Okay, so this is going to help people who were self-employed and maybe got a stated loan all those years ago.
Or a no income verification loan.
Right, because the automated portion of this is going to allow for a little bit higher of a debt-to-income ratio than on a conventional loan. So again, you may be able to refinance through this HARP program where you wouldn't qualify for a conventional refinance.
Well, let's talk a little bit about the borrower here. Are there going to be, I know you just discussed a little bit about income requirements, but are there any income requirements on this, or are they going to have their employment verified?
Well, that's not really like a black and white answer. If you look at the posted guidelines on efanniemay.com, here is what they say, and I'm going to quote what they say. The lender must obtain a verbal verification of employment, which we call a VOE, and verify the borrower's source of non-employment income, plus obtain any other documentation that's required by the automated underwriting system. So that system is going to spit out this little report saying that's what they're going to need from you.
So in other words, when somebody calls us in, we may not know if we're going to need the verification of employment. It's very possible that we may not need verification of employment.
Most of the time you won't.
If we input their information into the government computer system, the government computer system then spits out what it wants to see, and it may or may not have the verification of employment.
Right. Now, here's a little caveat for that. If the borrower's principal and interest payment is going to go up by more than 20%, they have to be requalified for the loan, including verifying all those income sources and the amounts and their assets and everything in according to regular seller's guidelines. And remember too, it's also going to depend on the lender that you deal with. Some lenders may have their own special guidelines, so you're going to have to check with the lender, because Fannie Mae has their own set of guidelines, but a lender can add to those if they want to.
So in other words, again, just give us a call right here in the office and we can go over all that with you. Tammy, you mentioned about increasing a payment of 20%. Why would somebody listening to this, why would they be wanting to go up on their payments? I mean, they're typically calling in to refinance to go down in their payment. Why the increase in the payment by up to 20%? What was that about?
Well, there's a couple things that may be happening. One is they may have an interest-only loan right now, or they may have like a artificially low interest rate right now that's getting ready to adjust big time. And so they would definitely want to refinance, and they may not be able to do that through the conventional guidelines that are out there. And so their payment may go up a little bit if they had an artificially low rate.
So in other words, if they had something like an interest-only loan and they're not paying off on the house, the new loan could have it so they're actually paying down on the mortgage, which would possibly increase their payment, but they're actually paying off on the house now.
Right. And also, they may be going from a 30-year loan into, it may be worth it for them to pay off their house twice as fast and go into a 15-year loan, or something like that. So it really depends on the situation, but there are some reasons why their payment might increase that 20%.
Okay, so for most people, the payments wouldn't go up, but for some of you that are either interest only, or if you want to accelerate and have a small increase in your payment, and then it pay off twice as fast. In other words, only paying for 15 years instead of 30. Just give us a call and we'll crunch numbers for you and see which works best for you. Okay, so I got that. Now, are there going to be any debt to income requirements? And explain what debt to income requirements are.
Okay, well, this kind of falls under the first section as well, but let's talk about what the DTI is first. The DTI is the income ratio between how much someone earns and how much they actually spend.
Okay.
So here again, some lenders may add their own guidelines as far as those DTIs are concerned. We call these overlays. Again, Fannie Mae has posted that they're not going to have any hard and fast rules about that, except for if your payment's going up by that 20% that we talked about.
Okay.
But the rule of thumb here is they have to be at or under 45% DTI or debt to income if that payment is going to increase by that 20%. Otherwise, there is no debt to income ratios that we're going to be looking at. So if somebody's in a 30-year mortgage and they're going to take advantage of a great 15-year rate that we have right now, and their payment increases by that 20%, they would have to go by that 45% DTI. Otherwise, no, there's not going to be one.
And again, to help you figure out what your debt to income ratio is, and on this training class, we're giving a lot of information, and we understand that everybody's at different levels. And so some of you might be very aware of of your debt to income, and that's fine. For those of you that's not, which frankly is going to be the majority of people, just give us a call here at the office. We can do a simple calculation for you and help you out with this. Now, what are going to be the credit score requirements on this new refinance program, Tammy?
Okay, well, I'm going to have to kind of bounce this back to, this isn't a black and white answer, just like the other ones weren't. But it basically says that Fannie Mae has not come out and said there's a very particular credit score minimum that they're looking for, unless that payment increases by that 20% that we were talking about. Now, if the payment does increase by that 20%, Fannie Mae guidelines said that they're looking for a 620 FICO score or above that. If not, and you're just someone who's in that 30-year mortgage looking to reduce your payment, there is no credit score requirement. However, we're back to those lender overlays or lender guidelines or whatever you would like to call them. Those individual lenders may have their own guidelines, and so you're going to have to go by a lender's guidelines.
So again, for most people, when they're looking to refinance, most people are going to actually be dropping their payment, and some very substantially as much. And for the majority of the people that's going to be dropping their payments by a substantial amount, what I heard you say is the government program does not have a minimum credit score actually spelled out yet. So again, give us a call here in the office, and we can help show you where you can get your credit score and give a copy of your credit report, which is not a bad thing to do anyway. Even if you're not looking to refinance, it's a good idea to see what's on there.
Right.
So let's talk a little bit about what about the verification of assets and reserves. In other words, do you have to show how much money that you have in the bank or in your 401k or in your checking account?
Okay, and we're going to kind of go back to that again. It really depends on if your loan is being done manually or through that automated system. For the most part, though, the answer is going to be no, unless that payment's going to increase by that 20%. If the loan is being automated, the system itself is going to tell you what you need. Most of the time, the answer is going to be no, but you have to rely on what the automated system tells you.
So kind of what I'm hearing here, just as a general statement, it seems like it's pretty relaxed guidelines that a lot of people may very well qualify for this, that the credit scoring is a little relaxed, the debt to income is a little relaxed, the how much money I have to have in the bank is a little relaxed. Certainly the equity in my home, where I could be upside down, is extremely relaxed. So I can be upside down in a big way in my house, and still this can be an answer. So I guess the bottom line, what we're saying is, give us a call here in the office. Let's look at your particular situation. And I know in the past, sometimes we've gone, gee, this probably won't work because nothing else has, and the country's in a little bit of a pickle right now. This is meant to be a very good answer for that. So really good stuff.
And while we're at that, let's talk a little bit about some of that. This is not what we call a loan modification. So you are not lowering how much you owe on the house. If you owe $125,000, you're still going to owe $125,000. What this is allowing you to do is to lower your interest rate.
Lower your monthly payment.
Right.
Get some relief there.
Yes.
And think about what you would do with that extra money. The money that you save on your mortgage could help pay for the kids' college, or maybe that much needed vacation to help relax after this very trying couple of years that we've had. So now, Tammy, we know that different people are in different situations. What if somebody either went through a divorce and they're looking to pull somebody off, like one person's looking to refinance and pull the other person off the mortgage because they're now divorced? Or let's say somebody just got married and they're looking to put somebody on the mortgage on a house that they already own. So if I want to add or subtract a borrower, can I do that?
That's a great question. First of all, let's talk about taking someone off of the loan, okay?
Okay.
It's not always really easy, but it is possible. What you have to do is you have to show evidence that the remaining borrower, the person who's going to be left, has made payments on that mortgage all by themselves for 12 months. So this cannot be a joint checking account with anyone else. It has to be a checking account in their own name, and they have had to have made those payments for the last 12 months. Then you can pull them off. Okay, now if you want to add someone on there, you can. I don't know why you would want to unless you really needed their income, but you can add someone onto. But they are going to have to qualify for that mortgage under the same guidelines that you qualified for the mortgage. Okay, so you can add them on, but they do have to qualify for the mortgage.
All right. Well, we've talked a lot about the actual homeowner or borrower. Let's talk about this loan itself. Is there a max loan to value? In other words, is there a maximum percentage that they can be at if the loan is more than the value of the home? Can they be too much upside down for this to work?
So the answer to that is, for the most part, there's not going to be a max LTV or loan to value if you're doing a conventional mortgage, like a 30-year or a 15-year or a 20-year fixed rate mortgage. Those are what we call conventional ones. So basically the answer is no. However, there will be caps on unique products. So if you're getting an adjustable rate mortgage or a 40-year loan, you want to extend it a little bit longer, there could be some caps on that. So you just need to call our office and ask.
All right, very good. Now, I've heard a lot about the appraisals I mean, really, these next two questions kind of all go together. Is there going to be an appraisal needed, and how will the value be determined?
Well, this is a really interesting question. So each loan requires field work, and an appraisal is part of that field work. So the following transactions, and these are straight from Fannie Mae guidelines again, can get a waiver for that field work. The first one is 1-unit properties, and the second one is primary residences, second homes, and investment properties. So the waiver is not going to be offered on co-op units, manufactured homes, 2 to 4 unit properties, and on any cases that may have gotten an ineligible when they pulled up that automated reading. But the long and the short of it is that most of the time there is not going to be an appraisal required, but depending on your file, it could. And as far as determining value, well, that's going to be done mostly through an automated system as well.
And so for most people, there's not going to be an appraisal required.
Right.
Okay. So what if there's a second mortgage here? How does that fall into place? Say if the house is worth $150,000 and they owe $150,000 on the first and $100,000 on the second mortgage. So in other words, they owe a total of $250,000. How does that work with the second?
Well, their second mortgage company, whoever has that loan, is going to have to agree to come in and be second in line behind the first mortgage. We call this to subordinate or a subordination. If they don't agree to that, the loan can't be done. I
guess that falls into, can a HELOC or a construction loan be rolled into one loan?
No, they can't on this product. This product strictly has everything to do with the first mortgage alone. If they have a second, they have to subordinate. If they're doing a loan where they're trying to combine two things, they cannot do it. We're just talking about the first mortgage alone right here.
Okay, so if there's a second mortgage, I can't roll them into all one loan.
Correct.
I'm still going to have two second loans.
And the second one has to subordinate behind the first.
And what about occupancy change? In other words, if they bought the house as a primary residence and now it's a second home and investment property, how does that work?
That's a great question. There's not going to be any restrictions on the occupancy types. Primary residences, second homes, investment, everything is eligible for this. So it just makes it great for everyone involved.
Very nice. And what if the property's for sale?
You used to not be able to do that, but it looks like right now that Fannie Mae is not going to have any kind of guidelines for that. But again, you're going to have to check back to the lender overlays or the lender's extra guidelines. But as far as Fannie Mae is concerned, no, there is not going to be any kind of exclusions for properties that are currently for sale.
Now, we know a lot of people have been under difficult times. And again, we're here to tell you guys, if your situation has been more difficult than some others, and we know that's been the case for a lot of people, first of all, we just want to let you know that it's not been your fault, that there's a lot of people going through a lot of hard times right now, and we're here to help you no matter what your situation. So, Tammy, in saying that, is there any seasoning or any length of time that has to go by if somebody has had a bankruptcy or a foreclosure?
Well, if you are smack dab in the middle of a foreclosure or a bankruptcy right this moment, it won't work. However, if you're finished, then basically Fannie Mae is not going to have any requirements. And we're just trying to help as many people as possible to be able to partake in this particular loan program.
And what about jumbo loans? And those are the people that have loans that are more than the average amount, like for the larger homes.
Well, in short, by definition, a jumbo loan is not been backed by Fannie Mae or Freddie Mac, so it wouldn't pass that test because these are only for Fannie Mae or Freddie Mac loans. Now, there are some areas of the country where they do have loan limits that are a little bit higher than the rest of the country, like Hawaii. They have a little bit higher loans than the rest of the country. So that's called a conforming jumbo. So if you have a conforming jumbo loan because of where you live, it will be covered by Fannie Mae and Freddie Mac because they already service those loans. But if you just have a general jumbo loan, sorry, no.
So to see which is yours, to see if yours is a jumbo or a standard conventional, again, just call here in the office and we can look that up for you real quick. Now, Tammy, how long is this program good for? I mean, this seems like a really good program, and we would certainly recommend that if you think this even may apply to you, please give us a call and let's get this going. As it stands right now, how long is it scheduled for?
Well, the scheduled end is going to be at the very end of 2013. So for anyone who wants to take advantage of it, Obviously, the greatest and best time is right now because we have no idea where interest rates are going to be next month, much less at the end of next year. So I would say right now is a great time to do that. And as we indicated from the very beginning, the whole reason we're doing this class right now is just to help people. And the reason we want to make sure that you move quickly is to make sure that if you qualify right now and you're eligible and have the ability to do it, that you get it done very quickly.
Yeah, and I tell you, I can't overemphasize that. Give us a call right now, and let's take a look at your situation. Even if it sounds like some of these parts may not apply to you, we want to make sure that you didn't misunderstand us, because this is going to work for a lot of people, and it very well could be you too. So, Tammy, when somebody calls in the office, how long are these loans typically taking to close? Is it kind of typical, or is it a little shorter, a little longer? What are you seeing?
Well, right now, it's kind of like a typical close. I think what you're going to have to look, though, is that, as a lot of people start coming into this program, there may be a tiny little bit of a bottleneck, so we may get a little bit busier. So right now, we're looking at typical time frames, but, it could just get a little bit busier, and so it could go to 45 or 60 days. So I would just stay realistic with your time frames. And if we close a little bit earlier, great. And you won't be frustrated, though, if it takes a little bit longer. The bottom line is you're being able to refinance when you never thought you were going to be able to refinance. So, patience is a virtue, but here it would be a great virtue.
Yes, this is a very good solution. So, very good, Tammy. One last question, and I think we've already kind of answered this. What if somebody isn't in Fannie or Freddie? Are they, just kind of left out in the cold, or what's going to happen with them?
I just love this question. No, they may not be out of luck. There are a lot of other programs. I think we talked about that at the very beginning. If they have an FHA loan, they may be able to do an FHA streamline, which again, they wouldn't have to have a lot of this jumping through hoops or qualifying to do. And because Harp is good to the end of 2013, just because you don't qualify today doesn't mean that in 6 months you won't qualify. So give us a call. We may be able to help with the things that are causing you not to be able to qualify, so that in 6 to 8 months you could, and by the end of next year you could be saving a whole lot of money.
All right, real good. Well, Tammy, we appreciate our listeners for hanging out with us and listening to us on this training class, and we're just here to tell you that we're here to help you. That's the reason that we're in business, is to help our people here in our community, and we really appreciate the time that you guys spent with this. Give us a call in the office and let us clarify the situation for you. We don't want everybody else to be taking part in this opportunity and getting lower payments, and you not doing it strictly because you misunderstood something, or you thought, geez, nothing else has helped. This won't help either, because that would be a very big mistake, and it'd be a very expensive mistake that we don't want you to make, and you don't want you to make either. So give us a call if it's after hours, or you think you're watching this at a time that you think nobody's going to be in the office. Just call the office, leave a message. We have some other contact information on this page, but do yourself a favor. Get the savings that you're entitled to, because you deserve it. I mean, this is a really very helpful program, and we want you guys to be a part of it.
Right, and like they say, if you don't ask, you'll never know.
Yeah, asking is free.
Yes.
And we're here to help you, and we'll help map out a situation for you that will work for you. So, again, thanks a lot. We appreciate you guys, and we'll talk to you when you call into the office.